All right. Good morning, everybody. So today we have more jobs, job numbers, jobs. Um, gas with nat gas doing that little back and forth, building the base. Maybe paying attention to gas at 10:30, but I wouldn't get too fired up on it. And then auctions. We had the 10-year, which provided a little bit of impact, and today we got the 30-year. So other than that, it's Japan. We gotta really keep our eye on Japan. A lot going on over there. I know it just doesn't get the attention that it deserves, but you know, this month, a lot of things are going on in Japan, historic stuff, and it can have major ramifications around the world. So, talk about flash crash kind of stuff. Europe went through this last year when they had a uh, new leader, and all she did was mention a potential policy change and screwed their entire monetary system up with those gilts. And, they're still trying to fix all of the chaos that came from it. So, with this new leadership at the Bank of Japan, we'll see. Right? We'll see. Today, it's still job numbers and the auctions. So, we do have another speaker today as well. The Fed hasn't gone into quiet mode yet. It'll be coming up real soon. And after those auctions, the afternoon is pretty much free and clear, which is nice. Don't have too much to worry about on that front. If you look at how Asia closed, they're continuing that move to the downside. So inside day breakout, continuation to the downside, but they are coming down into an area of support, right? Also, it's if you think about, supply and demand. So it's a Busby. It's a potential pivot point, potential support, all of those, right? Right now in Europe, after that nice pushback up yesterday, right back down again, and now we're inside day breakout and have expanded all the way to the bottom of the range. You could tell this has been an area where defense has come in before, just looking at all those wicks. The question now is, are those buyers that are down there, are they sated? Have they got their fill, or are they done? Because if they're done, then we're going to continue to go lower. You may not think it matters what's going on, over in Europe, but they are very often the tell for what our day is going to look like. Not always, but a continuation of. So we want to check more on this degrading day that they had, right? This breakdown after that potential reversal yesterday. Europe it's only 12:30 right now. They won't close until 10:30 in the morning at our time. So, they've got time to pull this back up off of those lows, and it's, worth seeing if they're going to manage to do that or not. Maybe they'll have something on there by the time we get wrapped up with TrendSpider. All right, so jobs, unemployment. The big one is tomorrow, but we still have job data coming in today, and then the auctions. By 1 o'clock, you're good. So you got The full house, 11, 11:30, and 1 o'clock. After that, 0 days are 100% a go. And then Bank of Japan. This is just the start of it. There's a whole lot going on over there that needs to be front and center. Before I leave this page, this is moving averages from the daily and the weekly, and we're on the ES. You can see how we're underneath all of them in the cluster, right? So if we were to go out to a daily chart or a weekly chart, we would have all of our major moving averages all clustered together. So a significant change event, right? You got this basing, bottoming pattern, and we're either going to make or break. But if we break to the downside, we'll be back underneath all of our major levels. If you kind of need the visual of what it looks like when it's a full string, that's the cluster, right? So the main thing right now is, are we going to keep it, maintain it, finally start getting above it, or we're going to break through that lower 200, which will put all of these overhead, and we start dealing with these lower levels again. Volume is within range. This is the cumulative overnight volume. As long as it's between 100 and 200, then everything is normal. If this morning's job numbers were going to be really impactful, we would expect this number to come in light as we wait for the market, right? As the market waits for the data. And that's not what we're seeing. So the market isn't waiting on the data today. It's well within normal range. But tomorrow, really expect this number to come in light, say around 80, while we're waiting for that big job number. Since we're within normal range, we can just turn it off. We don't need it. We have an ADR right now of 1.5, basically, just kind of round up a little bit. The initial balance last night was really small, and we left it pretty quick, and we've been kind of ranging around since then. We got a decent move out of the kill zone, which dried up. We've already reset it. Got a reasonably respectful low. So we got a lot of pivots now to focus on for the trading day, including the Globex low of yesterday, the RTH low of yesterday, and our own Globex low this morning. So lots of pivots on the downside here. ADR half 39.67 and a full ADR at 39.38. I continue to have people ask if I think that's too far away. No, I don't think that's too far away. It's this number right here. It's the average daily range. If that's what we've been doing on an average basis over the last 20 days, we can easily go there today. No problem. We're not just pulling numbers out of the hat, right? So we are still underneath the weekly pivot point that puts us in a bearish bias. We're still trapped midweek between last week's high and last week's low. So we've gone nowhere and we've done nothing all week. This is the size of last week's trading range. From last week's high to last week's low, we've done nothing. So a big old fat hurry up and wait, nothing. Not a surprise though, we talked about that last week, knowing we had Powell Tuesday and Wednesday, and even with his firebomb mic drop moment on Tuesday, we're still right where we started. So those iron condors talked about last week for Wednesday's expiration should be printing money just fine today. the expectation at this point is we need more data on the adjustment of the curve, right? Powell came out with the idea that 50 is absolutely on the table and is most likely what we're going to get for March. That had to be repriced all along the curve and push the pivot out. Now they're talking about the potential for another 50 in May. All of this is nearly priced in at this point. It hadn't been, which is why we had, the shock and the deep drop, but it's nearly there now. The probability numbers, the last I looked, were in the 70s. So, if we don't get a 50, say we only get a 25, the move to the upside is very likely going to be epic. But that's on March 22nd. It's a long ways off. What we have to worry about today is if the market's going to get ahead of the numbers for tomorrow. And I don't think it will. I think it's still going to maintain this choppy pause while it waits on the big data coming out tomorrow. And the Fed tried to soften that blow a little bit. On Tuesday, Powell made this little comment about how they're not deliberately trying to increase unemployment numbers. And yet it's one of the dots they use to see if they're accomplishing their goal. So while he says that's not the focus, he's not trying to cause unemployment. Seeing the unemployment numbers go up shows that the Fed is accomplishing their mandate. So if we get hot job numbers tomorrow, say a decrease in the unemployment numbers, then it still intonates the Fed has a lot of work to do, and that all of the damage that they've done so far has been for nothing. And as you can imagine, we're going to sell the hell off on some news like that. So good news is bad news and bad news is good news. It's good news if people are not unemployed, right? I mean, common sense 101. People finding work is a good thing. But if we have low unemployment numbers, this market's going down. So when you're looking at today and you're trying to think about what swings to take or what to do with your existing positions, just keep in mind tomorrow's numbers can very well reshape the narrative of where we're sitting and put us up to, say, 41.5 or all the way down to 38.5. Really easy. $10-day, 30-minute volume profile. We don't have a classic shape, and we are right at the point of control. When we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. We're in the middle. We are at the point of control. So a breakdown or a breakout, flip a coin. We don't have any way to tell. No amount of technical analysis in the world is going to give us a heads up on where the data is going to take us tomorrow. For today, the main thing is that we have to get out of this range that we're in before we have any good opportunities. Mapping out the 5x5, we don't have a VPOC from yesterday. We still have the one down below from 39.46, and we still have one way overhead at 4,100. I don't think that's on the table today. Now, could we go there? Yeah, but I mean, realistically, that's a long ways off. So I mentioned yesterday was a choppy, nasty day, and we knew it was going to be that way before the day even began. Simple little tip. If we're sitting inside of our own Globex range, price is going to be choppy and hard to trade. If we're sitting inside of yesterday's range, price is going to be choppy and hard to trade. So I'm not telling you don't trade, but I am saying if you're losing more often than you win, and you're still not a consistently profitable trader, quit doing the hard stuff and start doing the easy stuff. Really simple. Set an alert on the edges. And if price stays inside of this range, do something else. Trade options. Trade a different product. Go make some cookies. Go do something. When I was doing the trade reviews yesterday, there are trades even in a mess like this. So it is tradable, just not very good. I did get that distance from VWAP built yesterday. I need to monitor it for a few days, make sure everything is going the way it's supposed to go, and then I'll get that released into the Think or Swim workbook. I built it on an anchored VWAP, which is pretty cool because then we can use it, anywhere, any way we want. We're still within the weekly expected move. We haven't even hit the bottom yet on the ES. In the S&P, yeah, I mean, it's a different story, but on the ES, we haven't hit that low. And we're still really close to the 10-day moving average, less than 1% away. So, it shouldn't be a surprise, since we didn't go anywhere yesterday, that we're still within range of the 10. For the 10-week, we have expanded a little bit more. We're closer to that 1% number than we were yesterday. Yesterday it was 0.6. Today it's 0.8, but we're still less than 1% away from the 10. That's the takeaway, right? Whether it's 0.6, 0.8, 0.7, doesn't matter. It's still less than 1% away. When we begin to expand away from that 10-period moving average, we can go 4, 4.5, even 5% away from the 10 before we would need to consider that we might be overbought or oversold. Looking at the Linreg line from the swing low, swing high, a failed low, a reset on the high, another failed low. I might be using that word failed only from the context that we weren't getting these natural occurring swings on each side of the linear line. But what we are getting is higher lows. And now higher highs. Only higher than that one, but still higher highs. If we're going to have a trend, even if it's a reversal, it still needs higher highs, higher lows. A full set is 2. So 2 higher highs and 2 higher lows is a full set. Once you have a full set, you have a valid trend. Until then, you don't necessarily have a valid trend unless you're using something like OCR analysis rather than, say, the old school analysis. Well, we're not using OCR here, so we have 1 higher high. We have 2 higher lows. It's a good start. They still say that 2023 is going to be the year of the chop, the year of the grind, that we won't see, all-time highs until either very close to the end of the year, or, next year maybe. So we could see some new lows, but I think every analyst out there is on the agreement that even if we did see new lows, they're very likely going to be, say, like wick throughs or deep drops and recoveries, rather than a leg down and a continuation lower than that October low. There's still some really big threats out in the world, right? When you talk about climbing the wall of worry, and there's some really big upside threats too. Say, the one that I always use for an example of an upside threat is for some crazy reason, say Russia just bends the knee and bows out of the Ukraine, this market would explode to the upside so hard, right? That's an upside threat. It's not the only one out there, but it's always the easiest one to point to as an example of what that would look like. So yesterday I laid out the argument for a potential trade on Tesla, and it's called the TRB setup. What we were anticipating, what I was anticipating, was that we would get a recovery candle, we would get a drop down, a recovery candle, and that today we would get this gapped up breakout and a really big trendline breakover candle. I love those, by the way. I mean, they're awesome. And even if the whole thing falls apart like it did here, where we had a trend line and we had our recovery day and then we had our breakout day, and it wasn't, a phenomenal explosive one, but it still did its job, and it failed to follow through after that. It just crashed down afterwards. Even when they fall apart, that one tradable day makes it worthwhile to kind of keep your eye on. Only we didn't get it. So if we rewind to yesterday, that's what it looked like yesterday. And it's right there. So we were looking at the market yesterday, and we were anticipating a candle kind of like that we would, open gapped down, sink really low, and then rally back up and close near the highs. And that no matter where we closed yesterday, as long as it was near the open or the high of the previous day, we would be primed, set, ready to go for one of these big breakover days. But we didn't get it. Now, yesterday there was two trade ideas that I put out, either a continuation of this move to the downside or this trend line reversal with the big bar being today's play. If we continued to the downside, we had a target. It was the 1236 on the fib line. So it was really simple. We were either going to continue going lower and get to 180.50, or we were going to get the setup day so that today would be the trend line breakover and the big run up. We continued to the downside. So we didn't get the setup day. But what we do have now is the same setup. The potential today for that setup. So, don't get too hung up on where the line is going to be. We're going to bring it in a little. There's your 3 days, just like here, your 3 days. We would need today to be the flip over day, and we're down, we're down to 176 this morning, and we closed at 182. So we're down $6 more. We're down all the way down here. So far, this is not looking like it's going to turn around. It's looking like the continuation that we had talked about. But these 3 bars set us up for another recovery day. So during the day today, if Tesla rallies back up and closes anywhere up here, trying to close the gap that it now has, it gives us this day. That's the setup day. We need that setup day, right? Like there it is right there. It's the primer for this day, the day that we all want to trade, right? We want that one, but we have to get it primed first. It's like teeing somebody up in volleyball, right? You got to tee it up. Well, we're not teed up yet. And instead what we have is what the second trade idea was, that if we didn't get a tee up, that we would have a continuation to the downside. So we made it to our 1236, and that puts us at 180.52. That was yesterday's entire target. In a swing trade, it was 172. This morning we're at 176. So we're just about right there. 172 is not off the table. See how close we are to it already. So I am still looking for that setup day, that primer day where we drop down hard and then we rally back up out of it and close with a like a gravestone doji or just a regular doji, but a gravestone would be better. I'm a little picky on this setup because if you get a good one, it's a phenomenal move. I mean, it's just an absolute blowout play when you can get a good setup. And it generally runs back to the top of the range, generally, but it doesn't owe us that, right? Like here, where we had the good, nice, good, clean breakover day, and then it just stalled and down we went. We didn't even get the follow through all the way back up to the previous high. But more often than not, once you get that breakover day, you do get the follow through back up. Either way, you get that day. And for day traders, that's the only day we need. Screw the rest of it. So now with these 3 bars in a row, especially with their consistent gap and their consistent size, we are primed for one of these textbook breakover days, but today won't be the breakover, right? Unless they screw it all up. Today's just the primer day, the recovery day. So, like where we closed here, we opened here, and then we did that dip down and we came back up and closed. That's the kind of day we're looking for today. Something like this. If we don't get it, then we're going to continue to focus on the pivots. Then we're going to continue to focus on a continuation of market price, which would be that we get to the 172. This is what I have measured. It's the range that we were in. And when you measure a head and shoulders or a range, a wedge, anything like that, you want to plot 50% of this range, and then you want to plot 100% of that range. That's where the 172 comes from, and that's where the 157 comes from. It's just a measured move of a range. All right, the China ADRs are down this morning, more than 2.5%, and emerging markets about half that. So there's very likely 1 or 2 names in there that are really taking it down, and the rest are just sympathy plays. Those China ADRs, Baidu, Baba, PDD, JD, they're not hard to spot, right? Semiconductors also down more than 0.5%, really closer to 0.75%. Bonds are down this morning, which isn't good. Nat gas, another up day after the down day. still building the base, not a surprise. All right, so with these bonds, the danger day was the one that I had called out for the reversal, where I said, they had to come in. That was last Thursday into Friday. That was the reversal in the S&P that I had called out Thursday morning, that they had to come in and defend those bonds because this is like a major breaking point. So the weakness today, we're so far away from that level at this point that, even though we're a little weak, sure, we're nowhere near that must defend level. All right, so it's weak. We don't need it to be weak. We don't want it to be weak, but we're still not near a critical breaking point. That was last week. We can see the 10-year this morning still holding underneath that 4.01, but we're testing the highs of it, right? So we're in this top of this range. So really important idea today. We've had 2 days of sideways. Well, all right, just 1.5 day, right? All day yesterday, kind of all through the chop, all through the Globex of yesterday, the RTH of yesterday, the Globex today. The S&P wound up like a top, compressed with all this energy. It's ready to go. What's the catalyst for the move today? This right here. This is the fire for a breakout in the S&P. So if we see the 10-year, whether it's the TNX or, you can watch the futures like I'm looking at here, if we get a breakout above this high, we're going to get a leg down in the S&P. If we reject off of this high hard and fast, like we did Wednesday, and it takes this deep nosedive to the downside, the S&P is coming up. It's that easy, right? I hate that word, easy. That was easy. It's not that easy, but it's that easy. When we're looking at this today and we're trying to ask, what's the catalyst? I mean, we have some job numbers today, but they're not the numbers, right? Tomorrow's the numbers, the big ones, the ones that are really going to matter. So what's going to get us out of this range today? The 10-year. Now, if we reject softly, or we just don't break out of it, we just, continue to chop around in the 10 without significantly dropping, falling, ripping in one direction or another, then we're not going to get this breakout. It needs to be a rejection on that 10, steep, hard, fast to the downside. That will break us out of this range. Or if the TNX breaks through the top and gets above that 4 with conviction, starts to run in a rally, we're going to break out of the bottom of this thing. So really simple, inverse relationship. If one goes up, the other's going down. But it can't be a grind. It needs to be shocking, swift, convincing. Otherwise, it isn't gonna galvanize us out of this range, right? And you can back that up with, say, the Dixie. The Dixie got up into that liquidity, nice topping pattern, but it's at the lower end of this. And breaking through yesterday's low this morning, primed us into a classic double bottom. Remember, a good double bottom is a bear trap. It's what it's designed to be. The entire purpose of its existence is to trap bears. So it needed to go lower than the previous low to suck all the bears in and get them trapped for the breakout, or at least the rally up. So the trap is set. We are rallied up. Now we need the follow through, and that would be the dollar at the bare minimum getting it back above that 105.5, and even better, getting into like the 105.7 area. If we get a breakout on the dollar above, say, yesterday's high, and we get 10-year breaking out above 4.013, the S&P is going to go down like a brick in water. But the dollar alone won't be enough, right? It's a year ago it would, but this isn't a year ago. We got to adapt. Don't forget that today we have the 30-year auction. It's a really big deal. We had the 10-year auction yesterday. We got the 30-year today, and it matters. It matters a lot. Look at yesterday, 1 o'clock, 10-year auction. Look at that move. As 1 o'clock on the ES yesterday. All right, so keep your eye on this one. The base case argument for today is that we're going to maintain the range for one more day until we get into tomorrow's numbers. But after we close today and into Japan's trading session tonight, there could be a lot of moving parts that can break all of this before we even get to our numbers. So that's something to keep in mind. And knowing that that's on the table, we could see this breakout today, that it won't even wait for everything else, right? That it'll just go ahead and we'll see the 10-year follow through, the dollar follow through, and the S&P. So we're looking for a very convincing rejection here or a breakout. If we do break to the upside, there's a cog line at 40.11, and then we're into this volume right around that 40.20. 40.20 has been a big level the last couple of years. There's a lot of pivots all wrapped up into that one. So 40.20 is a big deal. It's going to be really hard to get through. You can see where price responded to it there, where price responded to it here. So if we try making a break up, we're going to have to deal with that level. It's shallow to get there. So if we do break out, we do have this shallow area. We should be able to move through that pretty quick. But once we get into 40.20, it'll be one heck of a fight. To the downside, there really isn't anything until 39.50. So if we break yesterday's low, 39.50 is the first target. Then there's a cog line at 39.31. The XLF continues to be a large part of everything that's going on. So, watching the financials will really help you out. They're slightly down this morning, not by much. And we don't have a solid level until around 34.05. These other ones are more of a minor level, 34.67, 34.50. We'd have to get below 34.90 first, and we are here in the pre-market. We're at 34.77-ish. So we're really close to this monthly level. Notice their recovery day and then the big breakover day. I'm going to keep pointing those things out until they're just so natural to you that you see them everywhere, because they are everywhere. Once you start seeing them, you can't unsee them. It's kind of like one of those Where's Waldo books. You start spotting that little bugger and you see them everywhere. Yeah, you like it. All right, so we were just looking at finance. Now we're looking at the monsters of tech. Now I really do refer to these as tech way more than I should, because it's not tech. It's the monsters of tech. It has a lot more consumer discretionary in it than it does tech. But this is the NY Fang, so it's all of those Fang names. And you can Google this and see what names are in that basket. And it has Baidu and Baba, and it used to have Twitter when Twitter was around. And it closed up on the day. A nice looking day, too, when you think about it. So we've got this split right now between tech and finance. All right, tech did reasonably good. You can see it closed near the high. Finance got the beat down yesterday. Now we did try to recover. We got overextended away from that VWAP, built a base, had what I call a failed flag breakout play, which turns into a really big cup and handle by the time we're done. And it got nearly back to VWAP. But on the other side of that, on the NY Fangs, we kind of have that same afternoon shape. But that afternoon shape was on the top side of the 5-minute open and not on the bottom side as it is on the financials. If we start to see these two work together today, up or down, it'll add to the fire for whatever move we're looking for. So right now, we're still seeing tech versus finance, and it needs to be tech and finance. That risk on or risk off works as a group and not this either or dichotomy that we're in. That needs to really dial back, swap over, right? Get everybody on the same page. We're primed for a topside move right now. Everything is there, but just because we have the setup for it doesn't mean we're actually going to get it. But I want to add that little bit of caution that we are set up for a topside breakout in the indexes this morning. First weakness, then the recovery candle, and then a nice breakout. Here we have a rally base, drop, base, but we don't know if it's going to be a base yet. We just have that early candle. But if you look at small caps, we are primed for it, right? So we've got 186 flat. We're down slightly. All we would need to see is a stabilization, that we hold the lows, start the rally, and then pivot by pivot, start working our way back up. We don't need IWM or DIA, but if we're looking for that rising tide, then yeah, we do, right? So 328 flat, nearly, right? Almost, kind of close. This was a really nice turnaround yesterday in DIA. And what would be good is if we actually opened in the pre-market above the previous day's open, or even better, all the way above the previous day, a complete inside day breakout gap up. The reason it's better to open up there is because then we won't have to fight to get through those pivot points. We'll be able to fade back onto those pivots like a springboard, find support, and continue to move up. If we open below those pivots, then we have to fight through them, and they're not a springboard. It still comes down to the 10-year. So you got to watch the news, watch the clock, keep your eye on that 30-year at 1, and watch this 10-year. It's going to be the catalyst. I still maintain that the market doesn't want this big move yet. They don't want to allocate capital until tomorrow's numbers, because tomorrow's numbers is one of those dots that they're going to use for their argument for the FOMC meeting on whether it's going to be a 50 basis point for May, not for March. March seems to be a done deal already. It's what are we going to do for May? Right there, the focus now shifts to US employment data due Friday and inflation data due early next week. All right, so we do have Bank of Canada at 145. They're going to give an economic progress report. I don't expect that one to have a significant amount of weight behind it, but still, you don't sleep on data, right? So I'd be a little cautious that the guy might come out trying to, out hawk the biggest hawk in the land. I doubt it, but it's still a threat that we have to recognize. Okay, so they've got him listed as mildly impactful. So not the most minor impact, but not a full-on impact, say like these Japan interest rate decisions that are going to happen Friday night. That's tonight, by the way, for us. So in Tokyo right now, it's 10:30 p.m. So when they do their Bank of Japan interest rate decisions Friday night, you can see how that'd be impacting us tomorrow. All right, WTI is still sitting in this range. It's still just cooking theta. It's an uncomfortable iron condor unless you legged into it. Same thing with Brent crude. And Europe is still sitting inside the zone. It hasn't broke down yet. But that wick isn't as long as when I started this morning. So it seems like it's fading back down to lows, may retest the lows for a breakout. Which reminds me, if they close at 10:30, you really want to be watching the ES today at 10:30. And you want to be watching these 10 years at 10:30. So a really big deal. Tie it all together, right? Watch the clock. Starting to get a breakout in the 10-year, by the way. Looks like a fake breakout, fast failure. That's the phrase, right? Fake breakout, fast failure. We get a steep, hard, sharp sell-off in that 10-year, we're going to see the S&P make a run for it. So that's what I got for you guys today. Be careful, be safe. Watch the clock. I'll see y'all tomorrow.